Welcome to the Iron Financial Explainer. We are here to help you forge a much stronger portfolio, absolutely cut through the market weakness, and rigorously inspect the structural integrity of the companies you're actually putting your hard-earned money into. I'm your lead analyst, and today we are bringing down the sledgehammer on analog devices, ticker symbol ADI. They just dropped their fiscal second quarter 2026 results, and let me tell you, the headline number is an absolute monster. We're looking at a record-breaking $3.62 billion in revenue. We are talking about a top-line print that didn't just quietly beat Wall Street's expectations, it completely demolished the consensus estimate of $3.51 billion. But look, I know exactly what the market skeptics out there are thinking right now. You're pumping the brakes, and honestly, you should be. We are living in a highly anxious macroeconomic environment. We've got sticky inflation, borrowing costs that absolutely refuse to come down, and stretched tech valuations across the board. So yes, $3.62 billion sounds like a massive concrete pillar of a quarter. But the real question is whether this is durable long-term strength or just another AI sugar high. Because seriously, as a skeptic, all you have to do is look at the broader semiconductor landscape right now. Everyone is just throwing around terms like next-generation compute and hyperscalers to get a bump in their stock price. It is incredibly easy to get caught up in the momentum when the entire market is desperately searching for the next big growth story. Are retail investors about to walk straight into an AI trap right at the absolute top of the cycle? Are they riding a temporary wave of enthusiasm, or have they actually forged an ironclad business model that can withstand a severe macroeconomic downturn? Is the structural integrity real, or is it just pure hype? Well, that is exactly what we are going to tear down and inspect today. We are skipping the fluff, we are going straight for the load-bearing financials. We're going to see if this company is forged from solid steel or if it's just painted to look like it.
All right, let's dive into Section 1, Inspecting the Concrete Foundation.
Let's get right to work and look at the hard financial blueprint. We have to stress test their operations to cut through any perceived market weakness. You can't tell if a foundation is settling just by looking at a single quarter in isolation, so we're comparing Q2 2025 directly against Q2 2026 to see if the core business is expanding or bleeding out. Year over year, revenue jumped from $2.64 billion to $3.62 billion. That is a 37% massive leap. But the real structural reinforcement here, it's all in the margins. Gross margin expanded from 61.0% to 67.3%. That's a 630 basis point expansion. And the operating margin? It went from 25.7% to a staggering 38.1%. For those of you not dreaming in spreadsheets, that is a 1,240 basis point jump, essentially doubling their operating income from $678 million to $1.38 billion. That level of margin expansion tells me they possess immense pricing power and serious operational discipline. They are doing significantly more with less, and they are pricing their products at an absolute premium.
But any good market skeptic is going to look at that and immediately search for the fatal flaw. You're probably asking, is this top-line revenue entirely propped up by one sector? Because if it's all just data centers, that foundation has a massive single point of failure. Well, here is the heavy lifting. That 37% year-over-year revenue growth was incredibly broad-based. It was spread across their entire footprint. This is absolutely not a one-trick pony relying on a single mega-cap customer. Their industrial segment, which makes up half of their total revenue, grew an astounding 56% year-over-year to nearly $1.8 billion. That industrial base is providing the rebar for this entire operation. We are talking about critical real-world applications in factory automation, robotics, aerospace, defense, and digital healthcare. That level of diversification definitely adds serious structural integrity. It proves they aren't bleeding in legacy sectors just to fund their newer AI projects. And the rest of the board? Communications skyrocketed by 79%, the consumer segment was up 23%, and automotive held incredibly steady with 2% growth. They are building on highly solid, diversified ground.
All right, so the revenue and the margins look solid on paper, but accounting tricks can easily make earnings look great. You absolutely cannot fake hard cash. How much actual capital is flowing into the vault? Well, their cash flow isn't just a vault, it is a literal fortress. Over the trailing 12 months, ADI generated $5.1 billion in operating cash flow. That translates to an unbelievable 40% operating cash flow to revenue margin. Furthermore, they brought in $4.6 billion in free cash flow, representing a 36% margin. Let that sink in. For every single dollar of revenue they bring in, 36 cents drops straight to the bottom line as free cash. This gives them immense, heavy-duty financial flexibility. A 36% free cash flow margin is undeniably ironclad. When you compare that to average legacy tech companies that are currently suffocating under high capital costs, this level of liquidity is a massive safety net. It means they have the raw materials to keep building even if borrowing costs stay elevated for years. And all that cash flow directly fuels their earnings power. We are looking at a massive 111% year-over-year jump in diluted earnings per share, hitting $2.40 on a GAAP basis. And if you strip out the noise and look at their adjusted earnings, it came in at $3.09 per share, completely crushing the Wall Street estimate of $2.90, a 111% jump that absolutely proves this is a solid structural build and not just top-line fluff. When your earnings per share is growing significantly faster than your revenue, it confirms that those 1,240 basis points of margin expansion we just talked about are flowing efficiently all the way down to you, the equity holder. It is not getting lost in corporate bloat or excessive overhead. But look, the stock market is a forward-looking mechanism. Everything we just talked about, it's already priced into the concrete. The skeptic naturally wants to know about forward momentum. Are they hitting a ceiling right now? Are they going to keep building at this aggressive pace? Well, they are projecting upward. For the third quarter of fiscal 2026, ADI is forecasting revenue of $3.9 billion, give or take $100 million. That is sitting well above the analyst consensus estimate of $3.62 billion. They're also projecting adjusted operating margins to hit approximately 49.0% and an adjusted EPS of $3.30 at the midpoint. And the real key here is their robust backlog. A strong backlog acts as a concrete buffer against short-term economic shocks. If new market orders suddenly dry up because of a random recession, a heavy backlog means the factory keeps running and the cash keeps flowing.
Now we move to Section 2, Heavy Lifting and the Empower Deal.
Let's pivot to the most aggressive structural move they have made this quarter. ADI isn't just sitting comfortably inside that cash fortress, they are deploying it. And this sets up a highly critical debate for us today. Are they making a brilliant strategic power play to solidify their moat? Or are they vastly overpaying to catch the AI wave at the absolute peak of the hype cycle? This is where your skeptical arm should be ringing extremely loudly. ADI announced they are acquiring Empower Semiconductor for $1.5 billion. And let's be explicitly clear, this is an all-cash transaction. $1.5 billion of that hard-earned fortress cash is going straight out the door to acquire a relatively obscure Silicon Valley company. Is this a trap? Did they just spend $1.5 billion on an AI-adjacent buzzword just to appease Wall Street analysts? Let's break it down.
We really have to weigh the heavy cost against the actual technological gain here. Yes, a $1.5 billion all-cash price tag is a massive structural load to take on, but look at the physical intellectual property they are acquiring to offset that. They are buying cutting-edge, proprietary integrated voltage regulator, or IVR, technology alongside advanced silicon capacitors. Now, why is this highly specific tech worth 10 figures? It is all about achieving true vertical power delivery. In the world of high-performance AI compute, physically delivering power to the processors is becoming a massive bottleneck. Historically, microchips used lateral power delivery. They pushed electricity from the edges of the chip inward. But as AI chips get incredibly dense and power-hungry, lateral delivery creates massive electrical resistance. It generates excessive heat, and the distance degrades the signal. Think of it like trying to force a massive fire hose of water through a complex maze of tiny garden hoses. Empower's technology allows for vertical power delivery, pushing power directly up from underneath the processor core. It is the final piece of ADI's grid-to-core power platform.
To really put this into perspective, let's look at the exact words of ADI's CEO, Vincent Roche. He stated flat out, the biggest bottleneck is we've got to solve for power density and delivery efficiency. He emphasized that time is absolutely of the essence right now. What he's saying is that the issue isn't just generating enough electricity at a power plant somewhere, it is the physical challenge of cramming that immense power into the actual CPU and GPU without literally melting the hardware. We can build the smartest, fastest AI chip in the entire world, but if we can't power it efficiently without setting the server rack on fire, it is completely useless. As AI compute scales exponentially, localized power density is the actual, hard, physical limiting factor. Hyperscalers are entirely constrained by thermal limits right now.
Let's go deep into the engineering specs for a second to see exactly why this technology does the heavy lifting. This IVR tech literally shrinks the power footprint on the motherboard by up to 4 times. Most importantly, it cuts data center compute power consumption by an estimated 10% to 15%, and it completely eliminates the need for dozens of bulky external components. A 15% reduction in power consumption is a massive structural advantage. For a major hyperscaler spending hundreds of millions of dollars annually just on electricity to cool their massive server farms, a 15% reduction basically pays for this technology overnight. Plus, shrinking the footprint by 4 times means they can physically pack significantly more compute density into the exact same expensive square footage. And because AI processing spikes violently during massive calculations, Empower's architecture provides an ultra-fast transient response.
This is absolutely not a buzzword. It is a highly foundational engineering solution to a billion-dollar physical problem.
Moving on to Section 3, stress testing the yield.
Okay, so the Empower deal makes solid engineering sense, and it might just fully justify that heavy $1.5 billion price tag. But we need to know if the company's structural integrity actually translates into durable yield for your portfolio. It is fantastic that they are building the heavy infrastructure of future AI power delivery. But what are they actually paying you, the retail investor, right now to hold this stock and take on this risk? Well, they are paying out aggressively. The board of directors recently voted to hike the quarterly dividend by 11%, raising the payout to $1.10 for outstanding share. An 11% hike easily beats inflation. It clearly shows management is confident enough in that massive cash flow fortress we analyzed earlier to permanently commit to a significantly higher recurring payout. You don't raise a dividend by double digits unless your concrete foundation can truly support it.
And this is a very long-haul commitment. This marks 22 consecutive years of consistently higher dividends. This isn't just some one-off hike to keep impatient investors happy during a single good quarter. Think about what 22 years actually means in the market. That means they were steadily raising the dividends straight through the bursting of the dot-com bubble. They raised it through the devastating 2008 global financial crisis. They raised it through the complete economic shutdown of 2020 and through multiple vicious semiconductor down cycles. That unyielding track record is the ultimate proof of long-term financial durability. It definitively proves they have an incredibly reliable, cycle-tested cash-generating engine. But let's rigorously look at the full picture here, because the skeptic is definitely noticing that even with the impressive 11% increase, the current dividend yield sits at roughly 1.1%. In an environment where a basic risk-free savings account or a short-term treasury bill pays well over 4%, a 1.1% yield doesn't exactly act as an iron shield for income-focused investors. So is their capital allocation truly optimal? Well, you can't just look at the raw yield percentage in a vacuum. You have to calculate the total capital return. In just the second quarter alone, ADI returned $1.3 billion to shareholders through a combination of those dividends and a highly robust share repurchase program. By aggressively buying back their own stock, they are permanently reducing the public float. This fundamentally increases your ownership stake and your mathematical claim on that massive free cash flow pool. A 1.1% yield combined with aggressive buybacks, 37% revenue growth, and massive capital appreciation potential is an incredibly potent, heavy-duty combination.
And finally, Section 4, the final verdict.
We've synthesized the hard data. We've broken down the heavy mechanics of the Empower acquisition, and we've rigorously stress-tested their 22-year yield history. Now it's time to weigh the iron against the rust and lay out the opposing forces acting on this stock. On the opportunity side, the upside is forged in solid concrete. We are seeing undeniable structural AI power demand. ADI is perfectly positioned to solve the critical power density bottleneck with their new vertical power delivery tech. They have record bookings across diversified markets, a $5.1 billion operating cash flow fortress, and margin expansion of 1,240 basis points. But on the flip side, we absolutely have to acknowledge the potential rust. The macroeconomic environment is dynamic and risky. Heightened geopolitical tensions and a fragile global semiconductor supply chain cannot be ignored. Any massive new export restrictions could severely crack this foundation overnight. Plus, the broader market is currently pricing in absolute perfection for any company touching AI. If demand falters, that modest 1.1% dividend won't provide much cushion if the valuation multiple compresses.
So, we throw the heavy lifting back to you. We've laid out the financial blueprints. Analog Devices is showing record revenues, massively expanding margins, and a bold, highly strategic acquisition aimed straight at the heart of the global AI power bottleneck. They aren't just touching AI, they are building the heavy physical infrastructure required to run it. But the macro environment remains unforgiving, and semiconductor cycles can turn downward violently. Is this company forged strong enough to withstand broader market weakness and sudden supply chain shocks? Does ADI truly have the structural integrity to be the ironclad anchor your portfolio desperately needs? Or is this premium valuation a heavy trap just waiting to spring? Review the hard data, weigh the fortress against the rust, and make your call. Thanks for joining us on this Iron Financial Explainer, and we will see you on the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.